These mistakes feel smart, but they cost beginners the most money. I know because I made most of them myself in my first year. And the frustrating thing about these mistakes is that none of them feel like mistakes when you're making them. They feel logical. They feel responsible. They feel like you're paying attention and being careful. But the outcome is almost always the same. You end up with worse results than if you had done almost nothing at all. In this video, I'm going to walk you through 7 investing mistakes that beginners make in their first year, what each one actually costs you, and the simple shift in thinking that fixes each one. Before we get into it, if you're new here, my name is Jonathan Allen, and for the past 9 years, I've been helping everyday people understand money in a way that actually works. If that's something you want more of, hit the like button and subscribe right now. Every video I make comes from real experience, not guesswork. All right, let's get into it. And before we talk about what not to do with your investments, I want to quickly address what's happening to your money if it's still sitting in a traditional savings account. Inflation doesn't pause while you figure things out. Every day your money earns less interest than the inflation rate. You're losing purchasing power quietly and consistently. That's not a reason to panic. It's a reason to move. The goal of investing isn't to get rich overnight. The goal is to make your money grow at a rate that outpaces what inflation is taking away. And as you'll see in this video, the way to do that is not through clever moves or fast decisions. It's through avoiding the mistakes that slow most beginners down. Mistake number 1, checking your portfolio every single day. This one feels responsible. It feels like you're staying informed, staying on top of things, being a diligent investor. But here's what actually happens when you check your portfolio every day. You see movement, and movement triggers emotion. Markets go up and down constantly, daily, hourly, sometimes by the minute. None of that short-term noise has anything to do with the long-term value of what you own. But when you watch it every day, your brain starts treating every dip like a crisis and every rise like a reason to celebrate. And emotional investors make worse decisions than calm ones. The fix is simple. Decide how often you'll check your portfolio and stick to it. Once a month is plenty. Once a quarter is fine. The less frequently you look, the less tempted you'll be to react to things that don't actually matter. Mistake number 2, selling after small losses. A beginner puts money in. The market dips 5%. They sell. They lock in a loss. Then the market recovers, and they've permanently missed the rebound. This pattern plays out thousands of times every day among new investors. And it's one of the most expensive habits in personal finance. A temporary decline in value is not a loss. It only becomes a loss when you sell. Investors who hold through downturns and wait for recoveries almost always end up in a better position than those who sell at the first sign of red. The calm example here is this. Imagine you bought a house, and a few months later someone told you it had dropped in value by 5%. You wouldn't immediately sell the house. You'd assume the market would recover and stay put. Your investments deserve the same patience. Mistake number 3, chasing popular stocks. A stock is all over the news. Everyone's talking about it. Your friends are buying it. You feel like you're missing out, so you buy it too, usually right near its peak. This is called chasing performance. And it's one of the most reliable ways to buy high and sell low, which is the exact opposite of what you want to do. By the time a stock is popular enough to be on your radar as a beginner, the big move has often already happened. The people who profited got in early, long before it was headline news. The fix is to stop making investment decisions based on what's exciting right now and start making them based on a simple, consistent strategy. Broad index funds, by design, take the excitement and the guesswork out of the equation entirely. Mistake number 4, over-diversifying. This one surprises people because diversification sounds like a good thing. And it is, up to a point. But beginners often take it too far. They buy 15 different funds trying to cover every possible sector and geography. And what they end up with is a portfolio so spread out that it becomes impossible to understand, expensive to maintain, and nearly identical to just owning one broad market fund. More investments do not automatically mean more protection. If you own a total market index fund, you already own a piece of hundreds or thousands of companies. Adding more funds on top of that often just adds cost and complexity without adding meaningful diversification. One well-chosen broad fund is genuinely enough to start. Build the habit first. Add complexity only when you have a clear reason to. Mistake number 5, changing strategy constantly. A beginner starts with index funds. Then they read about dividend investing and switch. Then they hear about growth stocks and shift again. 3 months later, they're looking at international funds. 6 months later, they're back to where they started, having paid fees and potentially taxes on every switch along the way. Strategy changes feel like progress. They feel like you're learning and adapting, but in investing, consistency almost. Mistake number 6, trying to time the market. This is the idea that you can figure out when the market is about to go up and buy in right before it does, or figure out when it's about to drop and sell before it falls. It sounds logical. It is, in practice, nearly impossible, even for professionals with entire research teams dedicated to the effort. Studies consistently show that missing just the 10 best days in the market over a decade can cut your returns roughly in half. And those best days almost always come right after the worst days, meaning the investors who sold during the panic missed the recovery entirely. The antidote to market timing is dollar cost averaging, investing a fixed amount on the same schedule every month, regardless of what the market is doing. You stop trying to predict and you start building. Over time, that consistency compounds in ways that clever timing almost never can. Mistake number 7, expecting fast results. This might be the most common mistake of all, and it's the one that causes people to give up right before things start working. Investing is not a short-term activity. The returns that make investing worthwhile, the kind that actually build meaningful wealth, happen over years and decades, not months. In year 1, your portfolio might not look dramatically different from where you started. That's normal. That's not failure. That's how compounding works, slowly at first, and then faster and faster as the base grows larger. A beginner who invests $200 a month for 30 years, owning a historical average return, ends up with significantly more than the total amount they put in, not because of any single brilliant decision, but because of time and consistency. The investors who give up in year 1 because results weren't fast enough never get to experience what year 10, 15, or 20 looks like. Stay in the game long enough for the math to work in your favor. Now, if you're watching this and you want a clear starting point, not just what to avoid, but exactly what to do and where to go, I put together a step-by-step guide specifically for beginners. In that guide, I cover 24 alternatives to keeping your money in a traditional savings account, options that give your money a real opportunity to grow, and most of them you can start with as little as $100. The link is in the description below. That's your next step if you're ready to move forward. Here's the one thing I want you to walk away with from this video. The biggest risk in investing is not the market. It's your behavior. It's checking too often, reacting too fast, switching too frequently, and expecting too much too soon. The market, over long periods, has historically rewarded patient, consistent investors. The question is whether you can be patient and consistent enough to receive that reward. Avoid these 7 mistakes. Keep your strategy simple and give it time. That combination is more powerful than any hot stock tip or clever strategy you'll ever come across. If you want investing explained simply, calmly, and without the noise, subscribe to this channel. 9 years of experience, broken down for real people starting from zero. And I want to hear from you. Drop a comment below and tell me which of these 7 mistakes you've already made, or which one you were about to make before watching this. No judgment, we've all been there. I read every comment and respond to as many as I can. Let's keep learning together. Thanks for watching. I'm Jonathan Allen, and I'll see you in the next one.